Welcome to the deep dive video update. This is a video that I do every week, and I need to explain a little bit about this title. Every week I do a video each day. I do a number of weekly videos, and then after I get done with the weekly videos, I go back through the charts and I look through those charts that maybe I didn't use in the daily videos, or maybe I didn't use them very often, and I put them into this video. There are also some additional videos that I use that are mainly just for informational purposes. I also put those into this video as well. The idea behind that is that we have to look deeper to try to find some insight as to what's going on in the market that we might miss by just looking at the other charts. And this kind of rounds things out by saying, okay, in the other videos, we really analyzed those charts. This video, I didn't use those, but we still might get some information and insight from that. This is being prepared for Monday, December 23rd. Before I get into that, there's a thing called the SPX investing program. It's a program I've developed, and from now until the end of 2024, it's free. You can check that out. There are additional videos that I post there. You get immediate access to the videos as they are available. There's a link that'll take you to the website below this video, as well as to a video that talks about the overall program. If you have any questions, you're more than welcome to send me an email here at the address that I provided. Also, this video, the deep dive video, it's just one of the weekly videos that I do. And all the videos that I do over the weekend are meant to tie into the daily video to get a big picture look with the weekly videos and then honing it down into a more refined look in each daily video. The first chart that you see here is a chart of the VIX. As a general rule, when the VIX is in a higher range, that means we're going down. When the VIX goes down into a lower range, we're typically in a bull market and really going up at that time. Well, right now, we've been going up a little bit. The VIX, there's been some fear in the market lately, even though we're not too far off of all-time highs with the Dow and S&P, the Nasdaq 100, all are setting recent highs. Now, this past week was kind of difficult for the market, but it had been holding up quite well and going up. And we're in a period of positive seasonality. We'll have to see if we can switch back over and have the market go up from now until the end of 2024 and into 2025. But we have been rolling over a little bit as the market's been going up. We just ticked up. You can barely see that over here on the right-hand side. I just use this for informational purposes, just to give us a general idea of what kind of a range is the VIX in right now. Another study that I do on the VIX is called the VIX and then a correlation with the S&P 500. And I'm not using this chart in the videos now because we're getting a very low reading. If we go up above this dashed line, that means the market's getting kind of nervous and we may not be getting any kind of clues from the VIX or the other studies that we look at. We might be getting some more insight from this particular chart, even though it is going up with the down week that we just finished. This is not giving us an extreme reading, so I haven't been using it in the video. Also, we look at the VIX, and then there's another thing called the VIX of the VIX, or VVIX. And we've been going down, and as a general rule, when this ratio is going down, that's more positive for the market. There are some exceptions here, but we ticked back up a little bit after we had this pretty difficult week last week. We also like to look at the speed of the VIX when it's really moving up or down quickly. And I did use this a couple of times over the past week because we were getting a very high reading as the VIX was going up. Now remember, the VIX goes in the opposite direction of stocks. If the VIX is going up or going down with stocks, this measures fear. And when this goes up, that means there's more fear in the market, which means we're going down at that point. Since that time, we've settled down a little bit. We've dropped under 20 with the VIX, and we're coming back more into a neutral range with how fast the VIX is moving. We look at the volatility of stocks as measured by the VIX, and then do a ratio of volatility of bonds as measured by the MOVE index. And this had been coming down, which tends to be more positive, but bond prices have been going down, interest rates have been going up, and then we had a difficult week with stocks, and we saw this ratio really shooting up as both became more volatile. And this is what we've been seeing a little bit more lately. as interest rates have been going up, and stocks were doing okay until about halfway through this past week, but it's turning this red line, and that's what I follow for the most part. It's turning this red line back up. Now, there are times when this red line is going down and stocks are going up. There's also times when the red line's going up and stocks are also going up. So we can't get a true relationship that's always the same from this chart. We use other charts to give us some context for this overall reading that we're seeing here. But lately, as this has been going down, that's been more positive because the VIX has been very low and that's helping stocks go up. Because this is a ratio between stocks and bonds, sometimes bonds have been more volatile, and that'll make the red line go up, even though stocks are doing quite well. In the past week, we saw just the opposite. Well, I guess volatility did pick up with bonds as well, but they also really picked up with stocks, and that's why we're seeing this turning back up. And this is for informational purposes, just to give us some key points and where are we now in relation to previous things that have happened in the market. We set a high in early January of 2022, and that was an all-time high at that point. Then we went into 2022, which was a very difficult year. And then we finally bottomed in October of 2022, and then we set another bottom in October of 2023. Well, going back to the previous all-time high, we're up 23.08%. Even with the declines that we've seen over the past week, this is still a pretty healthy return. And then we're up 69.72% from the low that was set in October of 2022, and we're up 44.52% from the October 2023 low that we set. Stockcharts.com has a thing called technical alerts, and this one's it's almost unusable to try to read the words. Just look at the colors here. We had a really significant down day on Wednesday, and all kinds of technical alerts ended up being triggered. That's why you see an awful lot of red here. So we look at this and just can see overall, okay, we started off okay in Monday's session. We read this from the bottom up. And on Friday, we saw an improvement. But along the way, we saw an awful lot of red happening here as the market was under pressure. Stockcharts.com also ranks different stocks or sectors or indexes on a score of 0 to 100. The higher the score, the better looking that particular chart. And it's trying to remove all emotion from looking at the chart. And then there's 5 indexes that I look at. The Dow, the S&P 500, which is what I focus on, the NASDAQ 100, the mid caps and the small caps, and I rank them according to what's doing the best right now. And back in first place, again, are the QQQs, which is the NASDAQ 100. Even though it was under pressure earlier in the week, it set all-time highs. But it's coming in first place at 88.5. When these scores get up into the 90s, that's when they're really strong. And this is the high 80s, so that's also a pretty good score. Excuse me. Coming in second place is the S&P 500. Even though it was down almost 2% this past week, it's still looking fairly healthy and holding up well. And that's what we're seeing. We're seeing the large caps, the mega caps, the stocks that everybody talks about. They got hit this past week, but they weren't down as much as some of the smaller stocks, some of the value stocks, some of the mid caps and the small caps. And so when that happens, the S&P tends to hold up a little bit better. In third place is the Dow, coming in at 76.2, which just a week ago Friday set an all-time high. Then we see the small caps, and this is what everybody's anticipating will go up. Well, they haven't started to do that yet. But typically what will happen is now that we're through the middle part and getting to the latter part of December, this is often when the small caps start to perform really well. Now, we don't know if that's actually going to happen. Historically, that's what's happened. But when you have everybody thinking something's going to happen, quite often the opposite ends up happening, or at best, nothing ends up happening. So we'll have to see if the small caps are able to really kick into gear. And then in last place are the mid caps, and they're showing some weakness right now as well, coming in with a score of 49.5. And a short-term chart that I look at here, it's short-term in the moving averages that are plotted on here are considered short-term, going from 10 periods up to 50 periods. And At the start of the week, we were up at the high end of the rainbow, and the rainbow continues to go up. Well, we had that big down day on Wednesday, and we're coming all the way down below the rainbow now. So this is causing the short-term trend to go from positive to negative, and we use other indicators to help us measure that. Now, this happened pretty quick, and so the lines aren't starting to roll over yet. The longer we stay down here, the more these lines are going to roll over and start to go down as well. If we could get back up and really see some strength and get to the top end of the rainbow, that'll keep these lines flowing up in the right direction. Then we have another rainbow going from 50 periods up to 100 periods, coming down into the rainbow and now coming back out of the rainbow. And we're pretty much on the top end of the rainbow currently. We closed just about at the 50-day moving average on Friday. The same thing here. The lines are still smooth and going up, but the longer we come down and spend time in the rainbow or even drop below the rainbow, the more these lines are going to roll over. But since it takes a while for these lines to catch up with what's happening, for right now, they're still pretty smooth and going higher. Then Bollinger Bands, and I did use this chart a couple of times in the daily video. There's a lot of different ways you can use Bollinger Bands, and this is just one implementation where we close down below the lower Bollinger Band, and that's what the percent B indicator measures. We get down below this red line because when that happens, first of all, it doesn't happen all that often. You can see the number of times, either positive or negative here, that we had a reading. And once we get a reading like this, it tends to not last very long. So it just means the market's getting a little too excited right now and is probably due for calming down. And what happens to work this off is we spent a couple of days down below the lower Bollinger Band, and then we started out the day below the Bollinger Band on Friday, but then we were able to close back up into the Bollinger Band above it, and so that's working off this percent B indicator. Then I hadn't even been showing the 50 period moving averages. Well, those have now come into play, so I'm using that in the daily video. The next major moving average that I use is the 100 period moving average, and we're still above these levels and the lines continue to go up. So, unless we continue to come back down and start to deal with these lines, I won't be showing this in the video either. But right now I'm showing both the 20, that's short term, and the 50, which is intermediate term. The 100 period moving average is somewhat intermediate to a little bit long term. And then I use the 200 period moving average to measure the long term trend. The CMB composite index, I did use this a time or two over the past week because this is an oscillator that goes extreme positive or negative. When we had the big down day on Wednesday, this did give us an extreme reading, but since then we bounced up off of that. The mass index is not generating a signal right now. We only pay attention to this when we get above the red dash line and the blue line. And although we're going up here, we're still a ways away from this chart even trying to tell us something. I was using this for a while. This is called the Pring bottom fisher, and it's really good at picking up bottoms, and then we come up out of that. Well, we had a pretty good signal back in November, even though we didn't see much of a decline here. And that ended up being, actually, it's up over here. We saw the breakout after the election and then the pullback. And then this started to cross over and actually gave us the signal before we started to go up. Now, right now, we're crossed over and going down. So this is not giving us any kind of a buy signal. This is when we really only pay attention to this, when the black line crosses above the red line. Well, now we have the black line below the red line. We like to keep an eye on how far away are we from the 200 period simple moving average. We're over 7% away. And we did drop down, but we're still above that 200-day moving average. And here's some measurements that I like to do. We're going back to the October 2023 low and then measuring how much we've gone up since then in a broader sense. And then when we start to decline, this is the all-time high that we set, and this is how far we've gone down to this point. If we continue to go down, if we get close to that 10% level, if we're still going to maintain a more positive atmosphere in the market, where once we get to that 10% level, that's when the smart money will come buying in, come in and start really buying with a vengeance. Now, if we break below, if we continue to go down and we're greater than that 10%, then that's when we go into a correction, and that's a more negative environment. So we like to keep an eye on this. Another momentum oscillator is the Connors RSI, where I only use this when we're getting an extreme positive or negative reading. And even with the down day that we saw on Wednesday, we never got to an extreme negative reading here. Anchored moving averages, where usual moving averages are ones that you're probably more familiar with, they use backwards data to come up with the current conclusion or current calculation of where they're at. Anchored moving averages try to project out into the future. And I have an anchored moving average going back to this previous low, and we did break below that. We're trying to come back up. If we could get back above this red line, that would be more positive. But yet, we're still above all these other anchored moving averages, and the lines themselves are going up, and that's positive. We keep an eye on the S&P 100, which is really doing quite well compared to the S&P 500. And that also shows us that the large caps are holding up better than the smaller stocks in the index. But here we're just looking for either positive or negative divergences or convergences. And they're more or less converging when we look at this chart. We don't see them really deviating from each other all that much. Then I have another long-term rainbow going from 50 periods up to 250 periods. This is the long-term trend. And even though we're coming down into the rainbow, the lines are still continuing to go up. So we're still positive there. A long-term oscillator is called the Special K, just like the cereal. And we crossed over in late 2023, and we've been able to stay above this red line ever since then. So this is long-term positive. And I don't show this in the daily videos because we get so few signals with this chart. Then just to make sure that things are kind of working with each other, there's a weekly chart of the S&P 500 on top and a weekly chart of the German DAX in the middle. The correlation right now is pretty strong. And as long as it's a strong correlation, we're like, okay, Europe and America, they're kind of the markets are kind of moving more in tandem with each other. It's when they get all out of whack. It's like, okay, what's going on in the US to make this deviate? What's going on in Europe to make this deviate? Right now, we're getting a pretty high reading here as the markets are mutually freaking out over the last week. Some support and resistance areas. Now, a week ago, when I did this, we were above this little mini rainbow. And what this is a 20 period simple moving average of the open, high, low, and close. Well, with the down day on Wednesday, we dropped below the rainbow and we're still below it. Now, if we continue to go up and we start to hit some of these lines again, I'll use that in the daily video. But since we're below the lines right now, I've dropped it from the video because there's really not much to show other than we're watching this little mini rainbow. The longer we stay below these lines, the more these lines may turn and start to come down. Possible fib retracements. This is going back to the all-time high. And if we really continue to go down, we'll hit one of these Fibonacci retracement levels here. But even with the declines that we've seen, we're still far away from those. A broad market measure, this is the Vixen, which is the VIX equivalent for the NASDAQ 100. This measures the volatility in the NASDAQ 100. I don't use this chart all that much, but when we were really declining with the NASDAQ 100, we did see the Vixen actually go up, but it has been dropping back lately with the update that we saw on Friday. Then on top is the S&P 500, and then we look at a ratio between the QQQs, that's the growth, the mega caps, and the Dow, which are considered to be more blue chip companies. What's kind of thrown a wrench into that is that Nvidia was recently just added to the Dow. So it's part of the QQQs and the diamonds here. And we see that the relationship between the Qs and the diamonds with the S&P 500 is pretty much neutral right now, as the mega caps and the big stocks have been holding up better, and the Dow's been under more pressure. The transports, which that's the red line that you see here, really had a bad week and a bad day, even on Friday. They bounced up a little bit here, but this just keeps an eye on, okay, the black line, that's the Dow, and the red line are the transports. And the market tends to do better when the red line is above the black line. Well, for quite a while, the red line's been under the black line, even though the Dow's been doing quite well. If we can get to an environment where the red line comes back up, even though these are on different scales, when the red line's above the black line, that would be more positive for the market. Then I've been using another ETF in the daily video called the Bank ETF, which I usually show in this video, but it's actually telling us something right now. So I don't have it here. But then another ratio that I look at are the regional banks. Those are the smaller banks with a ratio to the financial sector. Now, the financial sector has been under some pressure lately, but the regional banks, they've been even under more pressure as this ratio has been going down, even though it's still in an uptrend. We want to keep an eye on this because this is like Silicon Valley Bank, Republic Bank, New York Community Bank, banks that were in the news over the last year or two that were having real difficulties. And we keep an eye on this to see, okay, how's the market reacting right now? And ever since we had the big downturn here, we've been pretty much going sideways and we're in a general uptrend with this ratio. So we're hanging in there for the time being. I typically will use this quite often in the daily video, but we've been chopping more or less sideways lately. This looks at staples, which are more defensive, and the tech sector, which is growth. When this is going down, that means staples are underperforming. And we saw them start to kind of outperform there for a while. Now we've resumed a downtrend here, but we're not really moving all that much at this time. So even though I look at this and I bring it up in the daily videos quite often, well, I really want to see this moving for it to be a more useful chart. Then I have some rate of change charts. I use these for informational purposes. This is Friday's close, and then we go back 250 trading days ago. This is starting to come down as even our long-term look at the market has been taking a hit lately. Here's another look at that same chart, and we came back down below this blue line not very long ago, and we're continuing to decline right now. If this continues to decline, that's going to be more long-term negative. But if we can turn and go back up, that would mean things are shifting back over and looking more positive. Then bonds here, we look at TIPS, which are Treasury inflation protected securities, and do a ratio with 3 to 7 year bonds. And we were getting a little bit concerned because the overall uptrend was up, or the overall trend was up here. And that's what we were seeing back in 2021 into 2022 because Treasury inflation protected securities adjust for inflation. And folks tend to get into those more when they're worried about interest rates going up and inflation going up. And so that made sense. We were starting to go up a little bit more here, and that probably had to do with interest rates going up. Because you notice right in September, this ratio hit a very low value. That's when the Fed came in and cut rates for the first time, and we've been going up generally since then. Now, even though interest rates are going up right now, we're actually seeing this ratio going down. So that's a little bit positive for us, but we want to take this in the context of other charts that we're also seeing, such as this chart. Instead of looking at 3 to 7 year bonds, this looks at tips to 7 to 10 year bonds a little further out. Now, this is still going up. So we're not really seeing a confirmation. The previous chart, the ratio is going down. This chart, the ratio is going up. And so we're not getting a real clear picture from these charts. One's going up, one's going down. And so I haven't been showing these in the daily videos. And we look at the long-term bond ETF, that's bonds based on price, and compare it with the S&P, and we can see that the longer-term correlation is improving. They're having more of a tendency to go in the same direction at the same time. And you can see that where the red line was coming down, the blue line was coming down. That just shows the correlation is pretty strong. And then they both ticked up in Friday's session. And we also see on a short-term basis, based on 10 periods, that we've been going back up as well. We just want to keep an eye on the correlation between stocks and bonds by looking at this chart. And this is the same thing. We want to look at the relationship between the long-term bond in red and the QQQs, which is the NASDAQ 100. But this relationship is more neutral right now. We're right around the midpoint. Then also, just to keep an eye on how are US and European stocks behaving with each other here, we look at the 10-year yield in the US and subtract the German 10-year yield. And since US rates are higher, that gives us a positive result. And then we compare this to the US dollar index, and we see that there's a pretty high correlation between the two as we look at the interplay between interest rates and currencies. It's when this really gets out of line. That's when we're like, okay, what crazy thing is going on here? So to see this correlating together means that the stocks are moving in a more normal fashion. We keep an eye on the 2 year Treasury yield, and this typically when it spikes up and starts to come down, that will be positive for the S&P. Well, we've been going up, but we haven't really hit a spike yet. And there are times when we spike up here and it starts to come down, and stocks end up coming down too. So there's not a true relationship between the S&P and interest rates on this chart, but we like to keep an eye on it. But I'm really not getting any additional insight here, so I haven't been showing this chart. And then this is looking at European stocks and comparing them with American bonds. We're coming down to the lower end of the rainbow as the European stocks have been under pressure lately and interest rates have been going back up. Then I have some things called the possible positive scenarios. And some of these are actually giving us some insight, but not enough to really show them in the daily videos, at least yet. The first one is the percent of stocks in the S&P above their 200-day moving average. And we're coming down, but we're still above the green line. 50 is the line in the sand between positive and negative. So yeah, this is taking a hit, but it's still positive. Where we're looking a little more negative is when we look at the 50 period moving averages. And this is inside the S&P with those stocks above their 50-day moving average. We actually dropped below 50. Now we did bounce up a little bit on Friday, and that could be showing some signs of improvement, but the fact that we're below 50 is more negative. And then to get another comparison, we look at the mid caps, which are also showing some weakness here below their 50-day moving averages, and then the small caps, which are also showing some weakness. If we get back above the 50, both here with the small caps and on the previous chart, the mid caps, that means things are showing some improvement and turning back and looking more positive. Then we look at a ratio between staples and the S&P, and I typically will show this in almost every daily video, but we've just been chopping around lately. Staples are more defensive, and when this ratio is going up, that's negative for the S&P. When this ratio is going down, that's positive for the S&P. So thank you. I hope you found this helpful. I hope you get a chance to check out some of the other videos that I post. Have a great weekend, and I will talk to you in the next video.